Welcome to this latest edition of Fitch's Virtual Investor Series. I'm Cosme de Montpellier, Senior Director in Fitch's Cover Bonds rating team. Today I'm joined by Natasha Guerer, a Director in the Cover Bonds team in London. We are going to discuss the 2023 mid-year outlook and rating performance for global cover bonds. So Natasha, when we published our 2023 outlook report for cover bonds at the end of last year, we had our sector outlook for cover bonds as neutral, despite many sectors having theirs as deteriorating, for instance, European RMBS. Since the beginning of the year, we've had many things happening to the cover bond market. The cover bond market has been very active, with over 120 billion euro equivalent of issuances, benchmark issuances, as we see that issuers turn to cover bonds to refinance part of the cheap central bank funding that they received during the pandemic. But also since the beginning of the year, we've had continued increase in interest rates. Inflation is proving to be stickier than we anticipated. And of course, we're still in the middle of this cost of living crisis, which is impacting borrowers in many countries. So my first question is, do we still, despite all of this, have the neutral sector outlook for cover bonds?
Thank you, Com. Yes, our sector outlook for cover bonds is still neutral, and that's for four main reasons. First and foremost, the strong credit quality of financial institutions issuing covered bonds, as of course that forms the starting point for our covered bond ratings. Also, the prime nature of the assets included in covered pools, the large over-collateralization levels in programs, and contractual features which safeguard cover pool credit quality. And stepping back, interest rates are affecting banks, they're affecting cover pool credit quality, and interest rate mismatches in our programs. So we're going to talk about all these topics today. Looking first to the financial institutions, they are by and large in a much stronger position compared to when we were facing the global financial crisis. Revenues have benefited from rising interest rates, and asset quality indicators have remained solid. However, we do expect some overall softening in performance to start, and this is mainly due to pressure on earnings and asset quality. For example, we now have a deteriorating sector outlook for banks in New Zealand and Australia, and also in the UK, Germany and Italy. But here it's worth highlighting that the bank ratings are nevertheless on outlook stable, as all these banks have rating headroom. And bringing it back to our universe of Fitch-rated covered bonds, 98% of covered bond issuers have ratings that are on outlook stable or positive. 90% of ratings are investment grade, and actually 75% of our covered bond issuers have ratings that are rated single A category or above. So to summarise, banks are facing a more challenging environment going forward, but we're starting from a very strong place.
Now I want to turn to cover bonds and cover assets credit quality. So as you said, high interest rates is putting pressure on cover pool on asset quality generally. What about the impact of high interest rates on cover pools?
So we do expect some pressure on borrowers from stretched affordability, especially those on variable rate loans. But any uptick in arrears is from a very low base. We're coming out of a very benign environment in terms of arrears levels. And overall, we expect performance to generally remain strong. And why is this? Well, we already said the types of assets included in cover pools tend to be very prime. That's to say residential, owner-occupied, seasoned loans with limited adverse characteristics. So these should be more resilient to a downturn. It's also worth remembering that banks put into place much more thorough underwriting and stringent affordability testing in the wake of the last financial crisis. So for a lot of borrowers, interest rates would have already been stressed at the origination stage.
Okay. Are we more concerned on the performance of cover pools which are variable rate assets?
So this is the case for some Southern European countries, for example. So their cover pools do have some more variable rate loans, which could be more exposed to rising rates. However, these are also cover pools that tend to have mortgages that are low LTV, very seasoned and amortizing. So generally, these borrowers would be less vulnerable to rising rates. They're less indebted and loan balances are generally low.
Okay, so we expect the performance of residential mortgage cover pools to remain strong. What about other assets in cover pools?
So we do have some cover assets that could be considered a bit more risky. For example, in Spain, Germany and Denmark, we do have some cover pools with loans backed by commercial real estate. Typically, though, these tend to make up a small proportion of cover pools and are generally low LTV. For example, in Spain, since implementation of the Covered Bond Directive last year, it's no longer the entire non-securitized mortgage book of the issuer that's backing the Spanish covered bonds. Cover pools have become smaller and their credit quality has generally improved. So now our commercial real estate exposures in these pools is less than 10% and their LTVs are at about 40%. In Denmark and Germany, the exposures can be a bit larger. However, they're still low LTV and highly diversified across different industries. Another distinguishing feature is that these tend to consist of loans to operating companies with recourse to a business, so not only recourse to a property and its rental revenues. So we consider these a bit less risky.
One more question on cover pool credit quality. As you know, cover pools are dynamic, and then as we're seeing more issuances, we do expect issuers to top up their cover pools on a more regular basis. So are we concerned that these additions might worsen the credit quality of cover pools?
So the shorter answer is no, we're not concerned. Cover pools are dynamic, but as we said earlier, there are contractual features in place to safeguard cover pool credit quality. For example, many programs give a more limited credit to non-performing loans as part of their asset coverage tests. This obliges issuers to top up with performing loans or remove loans in arrears. And in practice, we tend to see issuers actively managing their cover pools. Most programs also have maximum loan-to-value thresholds. That tends to be 80% for loans backed by residential properties and 60% for commercial. So in these cases, the loan part above the LTV limit isn't taken into account as part of the over-collateralization calculation. And this is also a defense against property value declines, as obviously then LTVs would increase and issuers would need to top up cover pools.
Okay, and I guess most of our issuers may not even need to top up the cover pools if they have large over-collateralization buffers.
Yeah, that's the case.
Mm-hmm.
Most of our programs have an OC level which is substantially above the level in line with the Fitch ratings. Just to give an indication, more than 60% of programs have an OC cushion which is more than 100%.
Now I want to turn to the impact of higher interest rates on the excess spread in programs and generally the impact of higher funding costs. So most cover bonds are issued at a fixed rate, as you know, and as we're seeing more issuances at a higher coupon, this should inevitably impact programs. So what's the impact generally of high interest rates on programs?
As you say, if cover assets reprice more slowly compared to new covered bond issuance at higher fixed rates, this is going to increase interest rate mismatches in our programs, suppress excess spread, and ultimately could have an impact on our break-even OC for the ratings. For programs with mostly floating rate assets and floating rate liabilities post-swap, for example, in Australia, Canada, and the UK, rising interest rates should have less of an impact because asset repricing will happen faster, so this will flow through the programs. However, for programs that rely on more natural hedging, that have more fixed rate assets and fixed covered bonds, for example, in France, Belgium, and the Netherlands, there could be an impact on interest rate mismatches, just because it's going to be a slower process for the cover assets to reprice. But actually, this is slightly more nuanced than that, as it also depends on how fast the fixed rate assets will reprice, as fixed rate loans aren't necessarily fixed for the entire term of the loan. So, for example, in Switzerland and South Korea, we do have cover pools with a lot of fixed rate mortgages. However, they should still reprice quite quickly, so we don't expect too much impact in terms of interest rate mismatches for them.
Okay, thank you for your insights, Natasha, and thank you for listening to us. For more information about covered bonds, please visit us at fitchratings.com. And if you have any questions on the topics we discussed today, please send an email to the address on the screen. Thank you.